Hey traders, Raghee here, and in this free video we are going to talk about gold. Now we discussed this just the other day, talking about the width of the zone, the expense in terms of risk of that zone, and where we are right now. So, this is a really great example of how we don't want to necessarily be buying at higher highs, although, sometimes they can reward us, but other times we can be on the opposite end of a dramatic drop. So first of all, let's define dramatic drop, right? I don't say that arbitrarily. We have a high of 2015 and a low of 1941. So what does that tell you about the range? Well, it's easy enough to crunch the numbers. You've got a 74-point range, move to the downside. Now, where does that land within the historical price movement ranges of gold? We are well above the 68% probability. We're well above that, about 51, 52 point. So this would be a above average drop. In fact, I would actually call this pretty much rare air. And what that is I add the upper end of the highest price movement range we could see this week, 51, and then I add the highest hourly price movement range. So what you're basically doing here, just quickly, so you know what I'm doing, it's 51 points plus another 17. That's 68. It's amazing how when we exceed the higher end of the 68% probability of the typical daily movement, how we'll typically gravitate to the rare air, which is an additional upper end of the hourly. Now, if this is all a little strange, well, where is this data coming from? Why do we use it? It comes from a 6-month look back at the typical price movement range of gold, specific to the day of the week and specific to the hour of the day. And then I have different ways of crunching the numbers to come up with expectations of what price action could do. So I know today's a dramatic day, not because I see a large candle. That's subjective. We're holding a measuring stick to that candle saying, how significant are you? How significant is that drop? And in this case, pretty darn significant, 64 points versus that rare air of 68. Okay, where else has it landed? I know what I'm looking for. That's knowing the pitch. So is this a pitch? It absolutely is. This is on the upper end of our range. So typically in that area, I'll go with the GLD calls. The closer we get to 1920, 1915, 1905, I'll go with the GC December contract. Again, it's not for everybody in terms of the cost. We've talked about this in previous videos. However, GLD is a really great alternative. So let's talk about that. What do we have going on here? What we want to do is take a look at the money calls in GLD as GC, the futures, enters the zone that we would want to get long the contract in. But rather than spending the 9,000 and change for the overnight margin, we'll go out to the October 16, specifically the 182 calls, and we'll look to enter there. So check out the 182 calls as a proxy to putting on an overnight position in GLD. I'll see you in the next update.